If you have questions, please throw them into the Q&A. I will do my best to address all of them. And if we don't have time, I'll just send an email to Mike with questions, with answers to those questions. But I like it to be interactive. So agree, disagree, let me know what you think. So we got a lot of ground to cover. Here's a quick outline of some of the things we're going to go over. And then let's get right into it. So, this oil price shock was massive, and the next chart's even more indicative of it. But in just a few days, we went from 60 to 120, back to 80, back to 105, just in like 3 or 4 days with all these headlines. And I think the ramifications of oil higher for longer are more dire. The lower left piece shows Apollo's view of the impact of $100 oil on the economy. I think it's more pronounced than that, and I'm going to explain why in a minute. The upper right shows just the severity of the supply shock here. 20% of the supply disrupted, which is more than any other disruption in recent history. And so, the next slide shows just how impressive a move we saw over the last couple of weeks was, bigger than anything in the last 50 years. And it was a 5 standard deviation move, which you just don't see those types of moves all the time. So next chart. I think this is important. And if you get nothing else from my discussion on oil, please get one thing. Energy independence is critical for national security. And anybody who says otherwise, I would love to have that argument. You look at what's happening in Europe, in the Middle East, in Asia, in India, what's happening. Look at the difference. Historically, WTI to the various price types of Brent and what's happening in Dubai are $3, $4, $5 a barrel. And if you look just a couple of months ago in this chart, there was the difference between WTI and the basket was in single digit dollars. At one point last week, when WTI was trading at 95, Dubai crude traded at 180. So why did that happen? Well, because there's 3,200 VLCC stuck in the Strait of Hormuz, and they can't deliver oil to places they need to go. And so this chart shows why it's critical that the U.S. is energy independent, and it's a good thing it is. And so when I look at the world consumes about 102 million barrels a day. The U.S. consumes roughly 20 million. We produce about 14 million, and then we produce another 128 billion cubic feet of gas a day. We are largely energy independent. We do import about 4 million barrels a day from Canada, another 400,000 or 500,000 from Mexico. And that's really because we struggle to get oil from the West Coast to the East Coast because of a law called the Jones Act, which has been around for, 100 years. And it requires ships to be U.S. ships to carry crude to a U.S. port. And so the result is it's more efficient to get oil to the East Coast from other countries than the U.S. And we ship our West Coast crude that we're not using to other countries, that way. So that explains a little bit. Trump just did a moratorium on the Jones Act for 60 days during this melee, which is a good thing. But as increased bombing on countries like Qatar, Saudi Arabia, and UAE have happened, it has just wreaked havoc on crude prices. Obviously, the news today that Trump says they're negotiating is a good thing, and Brent is down 12% as a result. So let me just go to the next slide. This is another great example of reiterating my point about energy independence. Europe has famously relied on Russia and the Middle East for its natural gas. They got rid of a lot of their nuclear facilities and were very heavily focused on wind and solar and green energy. And we saw European natural gas go up as much as 125% in 3 weeks. It's down a little bit more than this today. It's trading at 57 right now. And so it's still up 85, 86% in 3 weeks, despite the news today. So it was funny. When Trump was in office, maybe 6 years ago, there was some type of a delegation, and he spoke to Germany and he said, "You're too reliant on Russia for your oil and gas, and it's going to come back to hurt you." The delegation laughed in his face. I think this chart tells you why Europe needs to be more energy independent, and it really hurts there. So this is a great chart. Let's forget what happened this morning. I'm still not convinced all is good, but this chart shows the flow of petrochemical products, and it starts with oil and gas at the bottom, and it goes through, it really touches so many things. And you saw chemical companies rallying and fertilizer companies, and then it's into clothing and packaging, and the end products are everywhere. And I have a story. I was playing padel, which is a sport I'm addicted to, and the guy I was playing with told me his cousin makes peanut butter in India, and they are no longer able to cook the peanuts because they're out of natural gas, and so it's indefinite when they can make peanuts. So you don't think, wow, I need natural gas to make peanut butter, but you do in the heating process, and the plants in India are so desperate for gas right now, they're paying way ahead of the spot prices in order to try and secure it. But this chart is why the 10-year Treasury was up 44 basis points before today in a few weeks for fears of inflation, given oil and gas is impacts so many things. So I have a question here from Albert. Everything I read in the Middle East points to oil to an extended crisis. In your opinion, is the craziness already priced into oil futures and oil price shocks, or is there still potential to see more? So I love the question, and I'm glad you asked it. If Trump did, I think Trump had to say what he said today because overnight, I wake up at 4 a.m. every day to check futures in case I have to start trading, and things were going ballistic. Sales, S&P was off sharply, oil was up again, and the long-term ramifications of $100 and $120 oil, and even Goldman Sachs and some of the other big firms were talking that it could hit 150 or higher, or even 200 for a period, then you get demand destruction, is so devastating to the global economy and the consumer that it is a major crisis, which gets back to my point from earlier, the most important point you get today, energy independence is critical for national security. So even though Trump has made some pretty loud statements this morning and this afternoon about heavy discussions with Iran and that things are moving in the right direction, and he's paused bombing, and just to catch up, over the weekend, Trump said he is going to bomb the power plants in Iran. Iran came back and said, we're going to bomb all of your desalination and American interest around the Middle East. And then Trump came out this morning at about 6:30, 6 o'clock and said, we're under discussion with Iran. Iran just 10 minutes ago on CNBC said, we have not had any discussion with the United States. What are you talking about? So I'm not sure if this is Trump trying to buy some time and get some more troops over there like he did when he bombed Iran 6 months ago. But I don't think this is over, even though we had a 12% sell-off in Brent. And I agree 100% that this is a major crisis if we see prolonged oil. And it's more than that. You know, these oil dislocations, this is a great lead-in, are not only crude oil and all these other things, these distillates that are used in gasoline, it's helium. Helium, Qatar accounts for 1/3 of the helium in the United States, in the world. And helium is used in a little something called chip manufacturing. It's part of the cooling process during etching for chips. And 1/3 of that is offline right now. Fertilizer, 1/3 of the fertilizer goes to the Strait of Hormuz. And if you think about it, we have the spring growing season where everybody's starting to plant here in coming weeks. And fertilization is key to crop yields. And so I agree that impact on future food prices could be pretty dramatic. So yes, I am very concerned. Lewis says, I wouldn't believe anything that comes from any official source, whether U.S. or Iran. And I kind of agree with that. I am not buying, I would be buying oil down 12% rather than selling it because I'm not convinced that all is good. And I'm in full agreement with Lewis's comments. But this chart just goes to show that it's more than just oil and gas. And like, I would have never thought about helium until this happened. I wouldn't have thought about the impact of fertilizer. And when you do not fertilize your crops, your crop yields are down dramatically. So what do lower crop yields mean? It means higher prices at the grocery store. Okay, so let's keep going. Next slide. So I'm going to pause for 10 seconds and say, if anybody wants to talk about Middle East oil, we can talk about it more. If not, I'm going to pivot to private credit. And we can always come back if you have a question later. These are some headlines in private credit. I've been doing private credit in some form or fashion since 1992. My hedge fund was largely focused in various forms of private credit. So I'm pretty well versed on the topic. And so we can go into a lot of detail on that. But, these headlines are a bit concerning. Let's go to the next one. I think this is a very interesting chart. So the upper left shows the exposure to software for the high yield market is under 5%. For the leveraged loan market, it's about 13%, but for private credit is about 21%. So when you look at the chart on the lower right, it's a growth in private credit. When you go from a few hundred billion to 2 trillion in assets under management in short order, you start chasing deals. And I know they're chasing deals is because one of the things I do in my family office is I make loans. I do hard money loans. And obviously I can't compete with Apollo and Ares making billion-dollar loans, but I make loans of $5 to $15 million out of my family office. And I was getting calls from these massive private credit funds looking for my deal flow. And I was like, you guys manage $10 billion or $20 billion in private credit. I'm pretty sure my $7 million deal you don't care about, but they did. And so the fact that there was not enough deal flow started generating worse outcomes for these folks, chasing software deals, higher leverage, worse covenants, worse terms in terms of yield. And so that's what happened. So let's walk through a typical deal in software for private credit. So let's just say a year ago, before the melee of AI, a lender would lend $2 billion, or it might be a group of 3 or 4 lenders, lend $2 billion to a software company. And at the time of the loan, it was 30% loan to value. They had a big equity cushion underneath it. Well, a lot of these software companies are down 40, 50, 60% on their stocks. And so that 30% loan to value could be a 60% loan to value today. And no one would lend 60% on software today. There's just, it's too aggressive. No one would do it. So that loan that was marked at par and it doesn't really trade is no longer worth par. That doesn't mean they're not going to get par back at the end of the day. They very well may, but if they went to sell it today, they might get 60 or 70 cents. And so that's the big dislocation in software around private credit. And you also have about 40% of the borrowers with negative free cash flow versus 25% in 2021. So as more money came into the system, we saw it with the tulip bulb craze. We saw it in 2006 and 7 in mortgages. And I'm not suggesting it's nearly that bad in private credit, but you have too much money chasing too few deals, and deal quality deteriorates. And that's what we have here. AI fears on job replacements mean fewer licensees. And then it also means that someone can disintermediate the software. So I owned a Padel facility here. I'm an investor in a Padel facility here in Florida, Padel and Pickle. It's 80,000 square feet. And I've been very frustrated with the software that we're using. It's an off-the-shelf software program that I just didn't like. I can't code my way out of a wet paper bag. I went to one of the partners that I brought into the deal with me, who was the CEO of a company that sold for $11 billion in the software space. And I said, hey, can you design something? He did by himself, vibe coding with AI in 3 weeks. He came up with the best software I've ever seen for a rackets facility to book, find games, and all the things that you struggle with when you're playing. He said, Eric, 5 years ago, this would have taken a year, $5 million, and 10 full-time engineers. I did it by myself in 3 weeks part-time. So put that out times 100, and that's why there's fears over software that are rummaging through. The top right shows the software maturity of loans and bonds coming up over the next couple of years, which is also a concern. So, you've had some redemption requests that are pretty big that had historically been about 5%. They were 7, 8, 9, 10, 14%. And then you have some banks with some exposure. The big comment I want to make here, if anybody's involved in private credit, is one about negative selection bias. So when a private credit manager says, well, we just sold a $300 million portfolio at par or 99 cents, aren't we great? Okay. You're selecting the best quality stuff that you can sell. And each quarter that you get more redemptions, you're selling your best stuff. And what you're left with, if you stay in the fund, is the most illiquid stuff that you can't sell or is so mismarked that they can't get out of it. And so my fear for those who are in this is there's this like prisoner's dilemma where you have to redeem. Otherwise, you're stuck holding the bag of the crap that they can't sell. So that's just something to think about, because I can tell you now, if you go through where they have some of these things marked, they're not marked anywhere near where they should be. And at one point at JP Morgan, my team was responsible for marking basically every loan in the market. So I'm pretty well versed sadly on this topic. Let's turn to positives. If there's anything that people have on private credit, we could come back to it, but I'm going to change the subject now. as I alluded to in the beginning of this comment, of the comments about how things are always volatile when Mike sends out an email about an economic update, at the beginning of the year, when we started the year, there were two rate cuts priced into the market. So the Fed was supposed to cut twice. As of last night during the melee, there was an 82% chance of a hike, and there was 0% chance of a cut as of last night. Now it's switched again on the Trump positive comments. As of an hour ago, it's a 30% chance of a hike, 60% chance of nothing, and about a 10% chance of a cut. And so the markets have changed dramatically. My point was supposed to be that in a rate cutting environment, stocks do well. And we're going to touch on that for a minute, but we're no longer really in a rate cutting environment. Earnings have been very strong. S&P earnings in the last quarter were up 13% and 12% before that. Stocks have held up relatively well. With the move today, we're probably off 5% year to date. And if I told you everything we're going to go through, that the S&P is only off 5%, that sure as hell doesn't seem like a lot to me. Inflation is down from its highs. And although unemployment is ticking up slightly, it's still low by historical standards. I'm not going to spend a lot of time on this chart other than to say this chart outlines returns over time in a rate cutting environment. Fed started cutting in September 2024, and there's been a handful of cuts. That generally means stocks do well most of the time. 2000 and 2007 were the exceptions to the rule, with pretty major catastrophes around there. So a good chart on U.S. consumer index prices. We're definitely seeing lower prices. You saw the very high inflation of years gone by, 2021, 2, 3, and even 4, which are now far more in line, even though the PPI last week was a little higher than expected. It was interesting that Mike Semblis is somebody I follow. It's a good fishing friend of mine. He runs strategy over at JP Morgan in the private bank and asset management. And he had a great piece out last week that I included in my newsletter that basically talked about demand destruction, saying if you have higher oil, to Albert's point, if you have a higher oil for too long, then it's just going to create demand destruction, which is 100% true. Around my community, gas went from $2.69 to $3.99 in a month. And I was getting my back work done. I have a bad back. And the young lady who was giving me an ultrasound, I said, "Where do you live?" She said, "I have to commute 40 miles each way to work. The incremental cost is $100 a month for me in gas, and I just can't afford it." So I'm going to pause for a second. I have a question from Lewis. What do you think all this does to real estate markets, residential and commercial and downtown office? Well, those who wrote off New York City for dead during COVID were wrong on the high end of real estate for office. They're getting up to $300 a foot at One Vanderbilt, in some of the best buildings in New York City. What we're really seeing everywhere is the Class C and B- buildings under siege. Those buildings on second, third, Lex, some of them are just unrentable and they're not really convertible. In my next note, I'm writing about things that happened, examples in Denver, Colorado, where some buildings have sold for 95% of the prior sale. It's interesting as a residential real estate broker. I do a couple of things in commercial, but primarily residential at the high end. New York City is on fire in many cases. High-end condos. There's a building downtown selling for $7,000 plus a foot. A unit just sold for $8,400 a foot downtown, unheard of. Where the weakest part in New York City is co-ops. Nobody wants a co-op. Townhouses and really and anything in Midtown is kind of under pressure. I don't think it's just because of this, but Lewis, we're going to talk about the consumer and we're going to talk a fair amount about real estate, so I'll tackle it more there. But I really think it's bifurcated. Come to Florida, Palm Beach Island and Miami. What has happened in the last month? Sergey Brin bought 5 houses. Larry Page bought 5 houses. Sergey Brin bought at least 1. Howard Schultz. Mark Zuckerberg paid $170 million for the single ugliest house I've ever seen in my life on Indian Creek. So what I would tell you is, policy in blue states is pushing wealth to Texas and Florida at the craziest levels. 5% billionaire tax discussed. That got $1 trillion of money out of net worth out of California. Hurry. Washington State passed a 9.9% tax on any income over $1 million. They never had an income tax before. Howard Schultz bought a $44 million condo at the Surf Club last week. So it is pushing out the wealthiest people. Ken Griffin left Chicago. for greener pastures in South Florida. He owns at least 15 homes between Palm Beach and Miami, and he has spent over $1 billion on real estate down here, and he hasn't even built his houses yet. So we'll talk more about real estate in a second. Let's go back to the slide. Let's talk about pockets of stress in the system, valuations at high levels, job revisions, consumer sentiment down, cumulative impact on inflation. I like this Bank of America talk of an E-shaped economy, private credit stress, which we talked about, and we're going to go through all these things. So for time, I'll just keep going. This is Warren Buffett's favorite market indicator. It hit 225% last week. And before today, this is not, I updated this as of Friday. So excuse me, it's going to be up a little higher today with the rally, but we're at 213%. What is this chart saying? It's the market cap of the United States over GDP. Historically, the median is around 95. Buffett thinks 70 to 80 is a screaming buy. 150 is nerve-wracking. Anything approach to 200 and you're playing with fire, to quote Uncle Warren. We were at 225 last week and we're probably at 215 today. Does that mean the market's going to crash? No. And we've been elevated for a little while. It means that that's a good example that markets are relatively fully valued coming into this. This is a great Bank of America chart that I crudely, and I did this intentionally, I wrote the little 2 data points afterwards because I like this chart so much I didn't know how to recreate it because I'm technologically an idiot. And so I added the 2 points. Note that in 2000, just before the dot-com bubble burst, we were at 5.1 times for price to book value. We hit 5.5 times last month, which was an all-time high. And on Friday, we were at 5.2 times. So we're probably at 5.3 times with the move today. When you look at the average is about 2. 1 standard deviation is 3.5. So we're 2 standard deviations higher than the average. Again, hard to say that the market is cheap with, with this valuation. Another example, this is a great JP Morgan chart. Again, I don't know how to recreate this, so I just wrote over it and updated as of Friday's prices. The forward PE is about 21.5, probably 22 today versus a 17 average. The CAPE ratio, cyclically adjusted PE, is at 38.7. It was up to 41 last week, so it's probably 39 or 40 today versus 28 average. So again, we are standard deviations above historical average. This is the last one. Price to sales ratio, we're at 3.3 versus a median of 1.6 and a mean of 1.8. This is not telling you the markets are going to crash. It's not telling you that I think 2008 is happening. To me, it's telling you that coming in to today's, the melee from the last few weeks, we were already pretty fully valued by basically every measure that anybody uses. Back to the consumer, subprime delinquencies have been on the rise. And what happened during COVID, we had a massive dislocation in autos where you couldn't get a car and people were paying up to 20% over sticker. I went to buy a car during COVID. My son got his license. I gave him mine and I had to buy a new car. And I went to a dealer and they wanted 18% over sticker. I was like, you are out of your mind. And I went to another dealer and I negotiated, actually got like 2% over sticker. But prices were out of control. Now people are trading in those cars from 2021 and 2022. They're 4 and 5 years old. And the average negative equity on a trade-in is over $7,000. So remember, you had 20% of car payments were over $1,000. And I think the average car payment was like $750 or some crazy number. So you're seeing increase in subprime delinquencies, and you are also seeing a slight increase in prime delinquencies, but at the bottom of the chart, but it's not meaningful, but you're starting to see it tick up a little bit. The index of consumer sentiment was basically at a 50-year low last month. It upticked a little bit with better data on inflation, but the consumer is under siege. They've tapped 401ks at a record rate. They're using buy now, pay later to buy groceries. Credit card bills are at all-time highs, and credit card outstandings are very high with 21% annual percentage rate, and it's really squeezed the consumer. And the biggest contributing factor is this chart right here. I had a prior chart that kind of outlined this, but the consumer has been squeezed with 5 years of much higher than anticipated inflation. If you read my newsletter, you knew my call. I was screaming and yelling, and I wrote 5 pieces dedicated to the idiocy of the Fed and the Treasury for keeping rates and quantitative easing going when the market was going crazy. And as a matter of fact, I told a crazy story. My sister lives in Hollywood, Florida. Most of the houses in her community are from the 50s. There was an open house for a 1,500 square foot house from 1950 with broken windows, termite wings, and a leaky roof. In the first half hour of the showing, they got 22 offers in July. I think it was July of 2021, while the Fed is buying $120 billion of bonds and keeping interest rates at zero. It just made no sense. And that really hurt the consumer. This is a good chart. So the one on the left is what I wanted to talk about. Bank of America put out a piece last month talking about the E-shaped economy. Everybody talks about the K-shaped economy, where the most affluent Americans are doing well. They're long stocks, they're long real estate, and the low-income households are struggling. If you look at a chart of home ownership, the average homeowner in America has a $440,000 net worth. The average renter has a $10,000 net worth. So it's literally 40 times difference to be a homeowner. The wealth is incredible. And I think this E-shaped economy showing the wealthiest are doing well. The middle class is just kind of struggling to get by, but treading water, basically maybe down a little bit, whereas lower incomes are getting hurt the most. A friend of mine that I worked with for many years at JP Morgan, who had a very successful career on Wall Street, called me from Carmel this weekend, and he showed me a picture of $6 gas that made my newsletter on Sunday. But he said, Eric, it's not a K-shaped economy. It's some Greek letter where the rich are so rich, it's ridiculous. He said, I'm spending $5,000 a night in my hotel. You can't get a room. And it's like you'd have thought it was a Holiday Inn for $100. So this is a great chart that just came out last week by the Financial Times that I want to spend a moment on, because I think it's a very powerful one. Let's go back 15 years. The bottom 80% and the top 10% were spending the same amount in terms of their percentage of consumer spending. It was about 43% each. Now the top 10% are spending about 48% of the US consumer, and the bottom 80% are spending about 37%. Again, it's like a K in the sense that the rich are doing all the spending and the bottom 80% are not spending nearly what the top 10% are. And I think this is dangerous. I think a long pronounced period of wealth getting wealthy and the poorer people not being able to get by is dangerous. The percentage of people who can't afford it's 45% of Americans can't afford a $500 emergency medical expense. I just don't think that's good. 22 states are in a recession. Not surprisingly, Florida and Texas are growing. A lot of businesses and wealth has come there. I can tell you South Florida is booming. I'm in the process of selling my house. I moved from New York City. I sold my co-op on Park Avenue in 2016. It's down 30%. My house is up over 100% in Florida because of the boom in real estate. And, not every state is doing well. You see 22 states shrinking. Back to the question earlier from Lewis about real estate, existing home sales are down due to affordability, between higher rates, which have really hurt people, as well as prices. So let's go to the next chart. This is a great chart that came out last week. Let's go to the pandemic. Free money is being given out. Interest rates are zero. Everybody's lending money. Home buyers outpace sellers by over 1 million. And that's where the bidding wars happened in 2021. Look at today. Sellers are outpacing buyers by 600,000. So you went from over 1 million more buyers than sellers to over 600,000 more sellers than buyers just recently. And there's a lot of markets that are really starting to slow down. Even in my community, which is really a hot community, prices are down, and it's definitely growing more notable, and the affordability is really an issue. And this chart should not make anybody happy. The median age of all home buyers has doubled since 1980. Look at first-time buyers. First-time buyers went from 29 to 40 since 1990. I just don't think that's a good thing. Now, it can't all be explained by prices and rates, because the younger people today are experiential. They want to go to a concert. They want to go to a fancy dinner. They want to go on a trip because they want to put it on Instagram, and you can't put your house as much on Instagram as you can in experience. And so kids are getting married later. They're not having kids. When your parents got married, they got married at 18 on the second date. Now kids, I went to lunch with a young man who's 36 and not married, and that was unheard of in the 50s, 60s, 70s, and 80s. So this chart is concerning as we look at repeat buyers have gone up 20 years since 1985, 37 to 62. So to me, this is very concerning. And as I said, being a homeowner means that you're going to have a much higher net worth, a 40 times higher, it's actually 43 times higher net worth than a renter. So this should concern everybody. If you read my newsletter, you know that I'm a deficit hawk. I don't know that anyone writes more about deficits and fiscal responsibility than I do. We are running deficits to GDP of 5 to 7%. The way the numbers work, roughly, we are about a $7.3, $7.4 trillion budget, and we bring in about $5 trillion in taxes. So we run deficits in the vicinity of $2 trillion. Over 50% of the budget is entitlements, Medicare, Medicaid, SNAP programs, probably 55%. We're spending about $1 trillion on defense, more this year because of the war. Hegseth just asked for another $200 billion, and about $1 trillion on interest. It's going to be a little bit more going forward as we refinance those low interest rate bonds with higher bonds. We just hit $39 trillion of debt last week for the first time, and it is something I am very concerned about. The only path forward to me, if I'm a politician, I won't be very popular, it's entitlement reform. We need means testing. We need to raise retirement age dramatically starting now. If you're 55, you're not going to get Social Security at 65. And if you're 45, it's going to be higher. And if you're 35, it's going to be higher. The average life expectancy since the start of Social Security in 1935 went from 61 years to 79 years, and we've only really changed Social Security benefits very slightly during that 90-year period. This shows government expenditures on interest. I was screaming at Yellen to refinance as many 10 years as she could. The 10-year bond traded at 31 basis points, and there was a bid for bonds in the trillions. We could have refinanced a lot of our short-term debt at under 1% for 10 years, but because inflation was transitory, they decided against it. That cost taxpayers trillions of dollars by not refinancing. And now this shows we're going to be at $1.4 trillion of interest expense, which is a huge number on a $7 trillion budget. One of the other things that is concerning me is what's happening in fertility rates. When you look at fertility rates, they've crashed. 1960, the average fertility rate was 3.6%. It is now 1.6% in America. And you look at what's happening in Asia, you look at what's happening in Europe. In some countries, it's under 1. You need a fertility rate of 2.1 to maintain a population. Why do we care? Well, we have an aging population that healthcare costs are rising double the cost of inflation. And in 1945, we had 45 workers per retiree because of the war. Everybody was building bombs and planes. In 1950, we had 16 workers per retiree. Today, we have 2.7 workers per retiree. And the math no longer works to support the elderly. So we have a huge upside down problem, as do many other countries. And so you add to it, immigration has slowed dramatically with a closed border, and deportations are happening, and our population actually, I think in 2025, actually went down slightly, or basically was unchanged for the first time in a long time. With this, hold on. I have a couple questions I missed. Let me go back to questions. We'll go. It's hard to see any chance of rate cuts given oil and anticipated inflation. I agree dramatically, Albert. As I said, as of an hour or so ago, there was a 35% chance of a hike, a 60% chance, or 30% chance of a hike, a 60% chance of nothing, and a 10 or 11% chance of a rate cut. I do not see rate cuts now, but that could change. You can thank blue states for that. I live in Washington State. Yes, I thank the blue states. I'm working with 11 buyers right now from $5 to $40 million for houses from Miami to Jupiter. And every single one of them is from Washington, Connecticut, New Jersey, Illinois, or California. So I agree with that. The complexity that is built into the financial system and the focus on short-term ROI are reasons that we are experiencing the pain we are. How do we shift to long-term and simple, transparent financial industry? I don't know who this person is, but I love this question. And this is the reason that I closed my damn hedge fund. What you just wrote, I closed hedge fund. I am a long-term thinker. I like to trade, but I like to put on thematic trades that last a long time. When I launched my hedge fund, I raised nothing but 3-year capital, which is an eternity for a hedge fund. And I was putting out thoughtful trades that I could take a multi-year view. When my 3rd-year anniversary came up, all my brilliant investors went to quarterly redemption. Well, one of the big issues you have with private credit is we have an asset liability mismatch where you have inherently illiquid assets and you have short dated liabilities, which is a recipe for disaster. I like to tell people hedge funds blow up, asset liability mismatch, leverage, and mandate creep. I told my investors that would never happen with me. So I had to start becoming a trader. When you have 3-month liquidity, it's very different. People want to know what returns are every day, week, and month. On a volatile day, my investors would text me, call me, how'd you do today? Why does it matter? You're not investing in me for a day. You're investing in me for my views over a period of time. I shorted the world in July of 2007. Guess what? I was early and I was wrong. And I lost money for a few months. But I kept my shorts on, and then my business made billions upon billions upon billions. I'm not going to time it to the nanosecond. So that whoever PMAC Shadow is, it's a brilliant question because we are too much of an instant gratification society. I have an 18-year-old daughter and a 20-year-old son. They go on Instagram and they see somebody with a new pair of shoes. They click it and they buy it. Immediately, they need to have the shoes now. My first job was at 11 years old washing dishes and cleaning toilets because I wanted a pair of Nikes for $18. And my mom said, there's no chance I'm ever buying you an $18 pair of shoes. So I got a job and I bought the damn shoes myself. And it was all the sweeter. I have a picture of me skateboarding in said shoes. I feel like Americans and the world has gotten to instant gratification and wants returns now. And you have to take a long-term view. I would rather be Buffett than the day trader that shows take a long-term view. So I love that question. Thank you. Carter data shows that from a tech standpoint, M&A is on the rise in the last couple of quarters. Taking all the information you shared, what do you think the trends are from M&A and IPO over the next 2 years? Love the question. So let's go over why that is. I don't care if we like Donald Trump or hate Donald Trump. There are things that I think he does very well, and there's a lot of things that irritate the hell out of me if I'm being frank. Donald Trump has lowered the regulatory environment, got rid of Khan, who was at the FCC blocking every M&A activity that you could possibly handle. And some of the early IPOs from a few years ago didn't trade well. So the result was a slower IPO market. When you think of what's happening in AI and what's coming public in coming years with OpenAI and some of these massive companies that are raising money at $800 billion, $1 trillion, SpaceX and these things, you're going to see a lot of IPOs over the next 12 months, in my opinion. And M&A activity is going to be more robust. Look at the deals in Paramount and Warner Brothers. These are massive deals that are happening that I'm not convinced would have happened under the prior regime. So I am very bullish on deals. With the backdrop, if we're talking about $100 oil in 3 months, we're talking about a recession. Moody's came out, a guy who's a little bit too bearish for me, but directionally I give him some credit, is the Moody's analyst who said that we have a 49% chance of recession in the next year. So recession chances have gone up. So if we're in a recession, nobody wants to sell in a recession, so that will go down. Absent that, I see M&A activity and IPO activity up. Impact on healthcare, I'm not sure what you mean by impact on healthcare, what impact on healthcare. So if you could put that in the chat, P. Machado, put whatever you mean, what impact on healthcare, and I'll answer it. Eric Rosen, prop tech space, any recommendations? I'll tell you, I did a podcast with a young woman that blew my doors off, and it was called... I'll have to think about it for a second. Mike, she's in 3i, Mike, and she's a Harvard grad who has this great prop tech business that was raising money. It was called Alfred. The company's called Alfred. This woman is an assassin, and I would, if you want to be in the prop tech space, I would 100% look at what she's doing. They're effectively automating apartment management and making it more efficient for owners of apartments and taking out management companies, and it's doing quite well. I was really interested in that. No one wants to pay tax, including me, but how do we close the deficit gap? Can we only fix it through cutting in Social Security? Let's be crystal clear. We do not have a revenue problem. We have a spending problem. When you look at the growth of spending, it is far outpacing our growth in revenue. And if we had a revenue problem, why is it that the biggest deficits are in New York and California? They have the highest taxes in America. California 1, New York 2. Why are they running massive deficit with high taxes? Because they waste money at every turn. Let's give examples. New York State spends $81,000 per homeless person. I lived in New York City for 25 years. Guess what you see? Homeless people everywhere. California spent $24 billion in 5 years on homeless. They have the most homeless people in America, and their homeless population grew by 50% while spending $24 billion. California just spent $20 billion on a train to nowhere. They've built 100 yards of track in 10 years, and now they said it's going to cost $33 billion, and it was supposed to cost $2 billion. So we have a massive spending problem. Look at what happens in New York when they're building a new train system. It's $20 billion, and in China, they build the same thing for $1 billion. So we have a spending problem. And Social Security, as I said, 61 years old when it started in 1935. We're 80 today. Healthcare costs are rising out of control. Three things need to happen to balance a budget. Last balanced budget was 2001 under Bill Clinton. Number one, means test. I will never get Social Security despite putting a hell of a lot of money into it. I don't expect to get $1. Raising the cap. I think the cap right now is $185,000. After you earn $185,000, you do not contribute anything to Social Security. They need to raise that. And three, we need to raise the retirement age. And as I said, if you're 63, we're not going to move the cheese. But if you're 58, we're going to move the cheese, and 55 more, 60, 45, 35. A 20-year-old today might not get it till 85. And that's what you have to do. There is no alternative. I was hoping Doge would be more successful. I took the other side of Musk when he said he'd save $2 trillion. I was hoping for $500 billion. We got nowhere close. If I had to make a market, I guess we saved $50 billion. Because remember, his cuts were multi-year cuts, and they put it all in 1 year. A little bit of false advertising. Am I worried about the AI bubble? I'm going to get to that in a second. Dan, I'll be right there. Eric Rosen, please drop your prop contact if possible. All right, Connie, I'll give it to Mike to give to you. So Mike, remember Connie at Reinvest. Fully agree with your point of views. Thank you. So I want to go back to the question who asked me impact on healthcare. P. Machado, I'm not sure what impact on healthcare, but I'll address it if you pop it in the chat. I'm not sure there is another one. So let's just go over this interesting chart by J.P. Morgan. Full disclosure, I bank with J.P. Morgan. If not, Mary Erdos would shoot me in the head, who runs a private bank. So one of the big key takeaways I want to say is, despite geopolitical fears, family offices are very underinvested in gold and crypto, which I thought was quite interesting in light of what goes on. But I have if you read my newsletter, I have all the charts. It was like 100 pages of charts, which were very good, but this is a summary. I don't want to belabor the point. I'm going to get to AI bubble for the person who asked that question. Dan. So let's talk about the positives and negatives. $1.5 trillion of spending, $2 trillion in 2026. AI has pushed GDP. JP Morgan estimates that AI CapEx contributed to 1% of GDP, outpacing the consumer, which is very impressive. Productivity gains are real. I gave the example. I'm going to give you another one. I was at a 3i dinner moderating a discussion on the world, not too different from our discussion today. And a gentleman sitting to my left is in the logistics business. He's the COO of a logistics company. 2 years ago, they had 40 computer programmers. Do you know how many they have today? One. They've saved $12 million a year on their engineers and software engineers and coding, because they're using AI to vibe code and to do everything. And they have not skipped a beat, going from 40 to 1, which is the most dramatic. It sounds like Elon Musk was in there a la Twitter. Healthcare and wellness. There's so many great apps now for healthcare and wellness. US is leading the charge, which is really important. I think it's all about AI. And then growth in robotics. Amazon uses Figure AI robots now. They lease them for $60,000 a year. One Figure AI robot replaces 3.5 people, and the 3.5 people would cost about $500,000, fully loaded with salary, overtime, healthcare, 401k, sick time, couch time, bathroom breaks, lunch breaks. And so, yes, employment is going to look a lot different in 5 years. The negatives, I do think we are in a bubble territory with bubble territory and valuations in some respects, and I worry about the spending. I don't think a lot of these companies that have spent trillions of dollars are starting to see the benefits of it yet, and I'm a little worried about that. The dislocations in software are real. These stocks, I ran a chart. I picked 21 stocks, and when I say it was at random in the software case, it was at random. I didn't even know what some of them did. And they were down as of today, about an hour ago. I ran it just before we started this. They were down on average 44.5% from the highs over the last 6 months or so. So they're getting killed. Financial services has been hit. Education. My son is at Wake Forest as a freshman. It will cost me $125,000 for his freshman year of college. The stated price on the website is $94,600. And I'm here to tell you, I'm not convinced a college degree is going to be worth $500,000. That's before fraternity or sorority or studying abroad. So I wrote a whole piece on this topic a few weeks ago that got a lot of attention. I'm on Substack under the Rosen Report, and it's free. Let's keep going. Overspending is definitely taking place. Big tech is very concentrated in the S&P. You have to be really a stock picker today. I don't think being long indices other than for a trade makes sense. Job losses are accelerating. I mentor 100 kids a year, try to help them get jobs, try to help them improve their resumes and come up with a story. I got 7 resumes today from kids from University of Chicago, MIT, the Ivy League schools, Cornell, begging for help getting a job because so many firms are not hiring in light of AI. Are growth expectations realistic? I'm not sure. Too much, it's different this time. A massive need for power. And then ethical concerns are serious. This is the hyperscalers. Everybody's seen this chart. I don't think we're going to be have too many data centers over the next 2 years. But I worry about what it looks like 5 years out and where the power we're going to get it. A lot of the grids, the California grid, the ERCOT grid in Texas are pretty weak. They have rolling blackouts quite frequently. And so I'm very worried about the power and what will happen. This last chart is something that I included in the last piece in our last time together. And I think it's a very powerful one. This shows the need for 8 workers to generate $1 million of revenue for the average S&P 500 company in 1985. In 2024, it was 2. Here's the only thing I can guarantee you, folks. I can guarantee you that if it's 2026, in 2030, that it's going to be 0.5, it's going to be under 1. It could be 0.5. So we're going to have gone from 8 employees to 0.5 employees over a 45-year period. Companies are going to be so much more efficient. What's happening at OpenAI, what Bezos is doing with his $100 billion money raise to effectively, as I understand it, buy a bunch of manufacturing companies, use AI-generated companies to clone what the manufacturing company is doing with people, and over time replace the people with the company that he cloned, for lack of a better word. And that's going to mean very few employees. So over time, this thing is going to be on an asymptotic line approaching 0. What does that mean for earnings? How are people going to make money? How is my son and daughter, my daughter's starting college in the fall, my son's a freshman, how are they going to get a job? What are they going to do? And is the $500,000 for private school worth it? The answer is no. SaaS is declining while proprietary data companies are on the rise. Yeah, data is everything. The reason that Musk is a genius is he owns all the data around Tesla and self-driving, and that is worth a lot of money. Data is where it's at, and the more data you have, the more you have. I mean, SaaS is declining because, number one, this chart shows that there's going to be a lot less licensees over the next 5 years. We're not going to, every company, the law firm that had 1,000 employees is going to have 300 or 400 because AI can do it better, faster, quicker than you can. And then a lot of these companies are going to just vibe code their own software. So over time, I believe SaaS is in trouble. Having said that, I like that final point. That is, I believe these SaaS companies have the ability to use AI to get rid of their employees and kick the can. I'm dating myself, but there was something called Yellow Pages that everybody used before Google. And I was buying Yellow Pages bonds at 10 cents on the dollar, believing that although it would die eventually, I thought it would last longer, and it did. And we made a lot of money because Dex Media lasted a lot longer than people thought. I think the death of SaaS is overwritten, and I think they're going to be creative, and there's very smart people leading these companies, and they're going to use AI and cut costs dramatically, and their revenues are going to go down, and they're not going to be able to extract the profitability that they've extracted, and they were trading at like 8 times revenues or some crazy number. I don't believe that is the case going forward. I don't know if there's any other questions. Let me see. Oh, shoot.
That leads into the next slides, Eric. Actually, I can
Okay, you haven't really
sort of
talked about
double click on
China,
that.
and BYD has more data than Elon. I will tell you, Dan, BYD is very, very, very impressive, and their price of their cars is amazing. I would probably buy one if I could get one, but you can't get them. and China is doing it. And think about it. I make, do I have my hat here? No, I don't have one of my hats. I have swag for my readers. I make hats in China. I can get them for 1/3 of the price of making them in the United States, despite airlifting them here and paying tariffs. So you can do it faster and cheaper in China. And I agree that BYD is really impressive. If we have that question back on healthcare, let me know. And thank you, Lewis, for that. So I'm going to turn it over to Mike. I'll stay on. And if anybody has any questions for me, I'll stay on till the end. And Mike can give you my contact information if you want to reach out and continue it. But I'm going to mute myself unless there's other questions for.
Thanks, Eric. I'll need you to just turn the slides. So let's just talk about, I think it was Connie, fully subscribed to your point of view. I'm just going to take us home here with a couple of slides based on where we see the private markets, and especially with the lens on AI, because that's our focus adventure forward. But just kind of piggybacking off of the conversation that was just had. I mean, look, if you look at where SaaS was, the median public SaaS company traded at 17.4 times revenue. Today, a number of them at about 8.1%. That's a 54% decline, the most dramatic valuation reset in cloud software history. And a lot of that is to what Eric was just talking about. Is SaaS dead? We don't know. But there's some SaaS companies that are going to die. The other ones are going to need to remake themselves. The power of AI, these SaaS companies are either going to need to buy or build, and it's going to remain to be seen what happens. But this is a pretty dramatic decline in a short period of time in the market, in my opinion. Next slide, Eric. This just looks at, if you look at the AI premium right now, this shows a basket of AI companies with their EV to revenue ratio, and you look at how these have climbed over time, but it's AI versus non-AI companies, and AI is trading in a premium right now. Some of these companies are at a 20x revenue multiple, and you saw the previous slide where the SaaS companies, some of them are 8.7 to 5x revenue. So there's a definite AI premium in the marketplace. Next slide, Eric. When you look at the available capital, and again, this data comes from Carta, and it's private market data. But if you look at historically over time with AI startups, if you look at 2025, AI startups are almost 41% of funding. That number is probably going to get closer to 50% in 2026. So the question on everyone's mind is obviously, is AI in a bubble? And the way that we look at it is, obviously you have to take a long-term view to everything. But yes, are there pockets of excess right now in the marketplace? I think so. And where are the areas of excess? Some of them could potentially, oh, sorry, Eric, I think you had removed the slide by accident.
Let me go back to it.
But the way that we look at it is that, could we be in a potential infrastructure bubble? Maybe, but there is some overspending in various areas. And I think that could be cause for some short-term concern. But again, you got to take a long-term view. But what has me nervous when I look at some of these deal structures out there is some of these circular deals that are being done in the marketplace. So, with some of the companies that are well known. So I think there could be cause for maybe some short-term concern, but I think there's going to be opportunities for big beneficiaries down the road.
Let me try and get this thing back a little.
Sorry, we lost the slides. We had a couple more
going
slides.
Back. Yeah, that's it. That was the last slide. That was the last slide. That was the last one.
Let me just pause there because I know we have 3 minutes, but let me just ask you a question, Eric, just to kind of sum it all up. You covered a lot of ground from oil to private credit to AI. From your standpoint, when you look at where we are right now, and I know you're a long-term thinker, where do you think some of the best areas of opportunity might lie?
Well, it's funny, when everybody runs for the hills, I think private credit is going to get very interesting. I think buying some of the private credit funds at big discounts could be interesting. I'm a big believer in Ares over the long term. I'm a big fan of Tony Ressler. I'm a big fan of Eric Getty and that team. I'm a little nervous on Blue Owl, but I think some of the Blackstone, BlackRock, some of these stocks are down 50% or more as a management, a parent company. I think those are pretty interesting. I think going through the software companies that you believe in, sometimes babies thrown out with the bathwater. I think that's interesting. Me personally, I'm continuing to make my biggest allocation is in private credit where I'm doing it myself. I'm making hard money loans and putting up 12 to 15, 16% returns on secured deals. That's what I'm doing where most of my capital is invested. And finding managers like yourself that you believe in that, you think are going to do well over the long term. You got to take a long-term view. And that great question about, the demand for immediate returns is really, really hard. When I look at the best investor of all time, it's somebody by the name of Stan Druckenmiller from Duquesne. He had a 32% track record of 30 years with no down years, broke the pound in like 1991. And he's a great trader, but he's a great long-term thinker, and he's going to where the puck is going. And I think you have to take a long-term view and make determinations. Whatever you're an expert in is where you should be investing if you have a competitive advantage from everywhere else. But there's always opportunities in markets. I am not convinced that this war is going to be over by the end of the week. I think Israel has a lot to say about it. And again, on CNBC, I'm looking right now, no negotiations have been held with the U.S. according to the Iranian parliament. While Trump is telling us that heavy negotiations and we're almost at a deal for them to give us all their enriched uranium and everything else. So the truth lies somewhere in the middle. One of our listeners talked about don't believe the press. Well, it's hard to believe what we're hearing by both sides. And so the truth lands in the middle, but take a long-term view. Any other questions? Did I miss anything?
I think there's one more question, I guess, alluded to is private equity is in trouble now. I think Connie, we share some similar views across many asset classes, but obviously private equity has been, something everyone's had exposure to over the past 15 years. And now you see these companies have been flipped 4 or 5 times, rising interest rates, a lot of debt, right? Where do you see that? I mean, is there a potential for a bubble to burst in private equity? What do you think?
I really like it. I've made money over time of investing in some of this stuff. And I would take a look at some of these private equity funds. Goldman has one, and there's a few others, secondary private equities. And as you think that private equity is getting killed, we just saw last year, we saw Harvard, Princeton, Yale, and a bunch of schools, Cornell, be forced to sell their private equity portfolios to raise cash because Trump cut them off from funding over the anti-Semitism on campus. And the result was their budgets were shattered and they had to sell private equity. And when you can buy high quality private equity with high quality managers at a discount, I'm taking a look at that. So yes, private equity is in trouble, but let's look at it as an opportunity for investment. My favorite line, I'm a big fan of Warren Buffett, even though he's not my favorite investor, Stan Druckenmiller is. He says something in my line that I steal from Warren Buffett. He's got 2 things that he says. I'm going to say both of them. One of them is be greedy when people are fearful, and be fearful when people are greedy. And so I like that. If you use that to invest over time, you're going to outperform. And the second idea, which I've stolen and written about extensively about all the questions about fiscal irresponsibility, is he said we can close this budget gap very quickly. If the deficit to GDP is over 3%, no one in Congress can run for re-election. If you made that, guess what? The deficit GDP would never be more than 3%. I want it to be at 2%, but those are the 2 big takeaways I have from Uncle Warren.
And then I guess one more question. I know we had a number of people drop off, but just since we're recording this, I mean, when everybody's talking about the public markets reopening and more companies going public, the barrier has gotten so high. I mean, in order to go public these days, right, you need a market cap of what, almost close to $1 trillion. I mean, how do you see that? How do you see that panning out over the next couple of years if these companies have to have,
We go through cycles. I don't think that's going to be. I mean, it happens that we're going to have some massive tech and AI related companies and SpaceX go public probably over the next 24 months, which are going to be huge. But that doesn't mean that a $5 or $10 billion company can't go public. It means that there's been a clamoring in the secondary and primary markets for this. I get shown a lot of these secondary deals. I just got shown Shield AI and some of these Palmer Luckey deals that are trading. I don't do it, but if you believe in these companies, Shield AI is trading. It was at an $11 billion valuation. there is a non-zero chance it's going to be $100 billion in 3 years. So there's a lot of opportunities in there. I think we have to be very careful about what's happening today and making a statement that it's going to be a trend for the future and always be the case. Yes, there happens to be a lot of very large companies that are going to go public, but I don't think that a year from now, if you have a good quality company with good management, have a good story to tell, and you have some AI moat or using AI to generate your revenues and you're inefficient with good margins, I'll buy that company. I don't need to invest in $1 trillion company. I don't like investing in $1 trillion companies because Microsoft was the first company of $1 trillion. I'm going to say 10 years ago, roughly. There are now 10 companies valued publicly over $1 trillion. Then we know there's a bunch more that are private. So we probably have 15 companies over $1 trillion when there was just one 10 years ago. So the bigger getting bigger.
I think we've answered all the questions. So thank you very much, Eric, for your time. We had record attendance, and for all those on the call, we will be sharing the recording over the next couple of days.
Thank you. Thanks. Appreciate it.
Thank you, everyone.